It's a $300 billion hedge fund niche, an industry built on spotting patterns in chaos and turning them into profit. These funds aren't like the rest.
By 2024, the total assets under management for the hedge fund industry was over $5 trillion, and the managed futures industry was over $300 billion.
While others falter, they perform. They profit from the extremes, riding waves of momentum that most investors fear to touch. Their strategy is unique, built on a simple, almost primal idea: follow the trend. Behind these hedge fund successes are the masters of trend following. Part mathematicians, part psychologists, these traders don't rely on instinct or gut feelings. They master their emotions, using discipline as their compass. They don't predict, they react. They don't guess, they follow. For these traders, success is built on discipline, patience, and the unshakable belief that markets will always reveal their trends. In 1783, James Mann founded a sugar brokerage in London, unknowingly laying the groundwork for one of the world's most enduring financial institutions. Just a year later, he secured a contract to supply rum to the Royal Navy, a partnership that would last nearly 2 centuries and cement the company's legacy. Over time, ED&F Mann expanded from sugar to coffee, cocoa, and eventually financial markets, evolving from a humble trader into a global powerhouse driven by foresight and adaptability. But through it all, one principle remained constant: following the money. Whether navigating the tides of global trade or the volatility of financial markets, the firm mastered the art of spotting momentum and riding it. This simple yet powerful philosophy transformed a sugar merchant into one of the most influential hedge funds in history. As James Mann was building his sugar brokerage in the late 18th century, the seeds of this transformative idea were quietly taking root, an approach that would later define trading itself: trend following. It wasn't yet formalized, but early traders and scholars, like David Ricardo, championed the ethos of cut short your losses, let your profits run. These words hinted at the core of trend following, an instinctive recognition that markets often moved in sustained patterns, if only one had the discipline to follow them. By the 19th century, the idea began to crystallize with the Dow theory, which codified the concept of trends as upward or downward movements confirmed by market action. Charles Dow was the co-founder of the Wall Street Journal, and he introduced what would become the cornerstone of modern technical analysis, the Dow theory. At its core, Dow theory aimed to formalize a key observation: markets trend, not wander randomly. Dow divided price movements into primary trends, long-term momentum up or down, secondary reactions, and minor fluctuations, short-term corrections or noise within the bigger picture. But what made Dow's insights revolutionary was his emphasis on confirmation. He argued that trends weren't defined by single data points, but by collective action. For instance, in the stock market, upward trends were validated when the movements of both industrial and transportation indices aligned, a reflection of economic strength across sectors. Dow's ideas were groundbreaking because they provided a structured way to observe and respond to market movements without predicting them. It was less about where prices might go and more about what they were currently doing, a philosophy that resonated deeply with the emerging concept of trend following.
I interviewed Richard Russell, the living guru at the time. Unfortunately, he passed away a couple of years ago. And I interviewed him. At the very end of my interview, I said, "Hey, Dick, what can you tell the next generation of technicians?" He looked right in the camera, classic. He said, "Never fight the primary trend." And that's Dow theory.
While Dow's ideas remained a theoretical framework, a new generation of traders was on the horizon, ready to transform his principles into practice. They would take these abstract concepts, turn them into action, and amass fortunes so extraordinary they would change the world of trading forever. In the roaring chaos of early 20th century Wall Street, one man stood apart: Jesse Livermore. His strategy was deceptively simple: follow the trend. Buy when prices climbed, sell when they fell, and let patience do the work. In 1907, he shorted the market during a panic, earning a fortune. And again in 1929, when his bold bets against the market collapse reportedly netted over $100 million. Despite amassing and losing several fortunes, his ultimate downfall came not from the market, but from his inability to master his own emotions. Following Jesse Livermore's era, the evolution of trend following as a trading strategy gained momentum. One man would come to define the strategy and claim it as his own: Richard Donchian. In 1949, Donchian introduced one of the first publicly managed futures funds, Futures Inc., revolutionizing trading with a systematic approach based on predetermined rules. His creation of the Donchian Channel, a groundbreaking technical indicator that tracked the highest highs and lowest lows over a set period, became an essential tool for traders around the world. At its core, the Donchian Channel aids traders in spotting breakouts and following trends by drawing two lines, the highest high and lowest low over a set period. Here's how it operates. The upper line shows the highest price in the look-back period. The lower line shows the lowest. These lines form a flexible channel that widens or narrows with price shifts. A price breaking above the upper line hints at an upward trend and buy signal, while a drop below the lower line suggests a downward trend and sell signal. By the early 1980s, trend following had evolved into a widely respected strategy, drawing in a new generation of traders and fund managers. Yet, an enduring question lingered. Could anyone master this strategy with the right training? Or did success require an innate, almost instinctive talent? Amid this uncertainty, one man would step forward to settle the debate with an experiment that would transform the world of investing forever: Richard Dennis. Born in 1949 into a modest working-class family, Dennis displayed an early fascination with markets. By the age of 17, he was working as a runner on the floor of the Chicago Mercantile Exchange, soaking in the frenetic energy of the trading pits.
Well, I'm not sure it was quite legal, but I started to trade when I was about 17. And there were some books, but they were by people who are long gone about trend following. And I just started to do research just by hand way back then.
But Dennis wasn't content to remain on the sidelines. At 21, with a borrowed $1,600, he entered the trading world himself, purchasing a seat on the Mid-America Commodity Exchange, a smaller market that allowed him to trade in mini contracts, perfect for his limited funds. His early trades weren't without setbacks, but Dennis was determined, meticulously observing the patterns and rhythms of the market. In time, Dennis perfected his strategy: trend following.
I don't believe markets are random. They move in trends, and if you can spot those trends and ride them, you can make serious money. It's not about predicting the market, it's about reacting to what's actually happening. I stick to a set of rules. Cut your losses quickly, let your winners run, and adjust your position sizes based on volatility.
His breakthrough came in the volatile commodity markets of the 1970s, where he turned a small stake into millions, earning him the nickname Prince of the Pit. But for Dennis, it wasn't just about the money. He was determined to prove that trading wasn't an innate talent, but a skill anyone could master with the right mindset and system. By the early 1980s, Richard Dennis had already cemented his place as a legend in the trading world.
Back then, I was running my trading firm, C&D Commodities, which I started with my partner, Bill Eckhart. We were doing really well, managing tens of millions in both client and proprietary capital. At one point, I had about $200 million under management.
But for Dennis, trading was more than just a career. It was a philosophy. He believed that success in the markets wasn't about innate talent or intuition, but about following a system, one anyone could learn if they mastered the right rules and mindset. This belief, however, wasn't shared by everyone. Dennis's closest confidant, Eckhart, was skeptical. He argued that trading required a rare instinct, something that couldn't simply be taught. Dennis disagreed, and the two found themselves locked in a friendly yet fierce debate. Could great traders be made, or were they born? Determined to prove his point, Dennis decided to put his theory to the ultimate test. He envisioned an experiment. He would take a group of complete novices, teach them his trend-following methods, and give them real money to trade. If they succeeded, it would settle the debate once and for all. It was a gamble unlike any the trading world had seen. Dennis wasn't just risking his reputation, he was putting millions of dollars on the line to prove that success in the markets could be taught. What if his students failed? What if his methods couldn't be replicated? In 1983, Dennis placed ads in major financial publications, offering to teach his proprietary system to anyone willing to learn. Prior experience wasn't required, only the right attitude and an ability to follow rules. Applicants came from all walks of life: a security guard, an Air Force pilot, even a blackjack player. Dennis believed diversity was key. He wanted people who could think unconventionally and adapt. Over 2 weeks, Dennis and Eckhart taught these recruits, later dubbed the Turtles, everything they needed to know about trend following: how to identify market trends, manage risk, and execute trades with discipline. For Dennis, this wasn't just about teaching them to trade, it was about proving that with the right system, anyone could succeed. As the training ended and the recruits prepared to step into the markets, Dennis couldn't shake a lingering uncertainty. Would his carefully crafted system hold up, or was he about to watch his grand experiment unravel? The results of Richard Dennis's turtle experiment would go down as one of the most extraordinary chapters in financial history. Starting with accounts of $1 million each, the turtles produced returns that stunned the financial world. Collectively, they generated hundreds of millions in profits. Some, like Jerry Parker, achieved annual returns exceeding 100%, transforming their small beginnings into fortunes. Parker, who would go on to found Chesapeake Capital, became one of the most successful trend-following traders of all time, managing billions and exemplifying Dennis's principles of risk management and discipline. Curtis Faith, just 19 when selected, quickly rose as one of the most successful turtles. Managing some of the largest allocations, Faith delivered spectacular results early on, though his high-risk approach occasionally led to significant losses. Liz Cheval, a key figure among the turtles, combined discipline with meticulous execution, proving that Dennis's rules worked across diverse personalities and backgrounds. For Dennis, the experiment wasn't just about creating successful traders, it was about proving that virtually anyone could master the markets with the right system. By the end of the turtle experiment, Richard Dennis had achieved what many thought impossible. His students, plucked from obscurity and trained in his systematic trend-following methods, had proven his point beyond doubt. Trading success could be taught. His students continued to shine. Jerry Parker's Chesapeake Capital became a trend-following powerhouse, managing billions and earning the respect of institutional investors. Liz Cheval and others carried forward Dennis's principles, proving the enduring power of the turtle system. While Dennis becomes a legend of the past, in 1997, one man aims to build his own legacy in the world of trend following. His name is David Harding. Born in 1961, Harding's early life laid the foundation for what would later become a groundbreaking career in finance. He began his journey as a brilliant student of natural sciences at Cambridge, where his scientific mindset was shaped. Entering finance in 1982, he worked as a trader at Johnson Matthey & Wallace, discovering his passion for futures markets. At Faber Fund Management in 1985, he embraced systematic trend-following strategies.
A great number of hedge fund managers in these subspaces of trend following and systematic trading have strong backgrounds in math and science. I think it's because the scientific method, or mathematical thinking, lends itself very well to quantitative finance.
In 1987, Harding co-founded Adam, Harding and Lewick, AHL, with Michael Adam and Martin Lewick. The firm became an early adopter of algorithmic trading, leveraging quantitative methods to identify and capitalize on market trends. But after being acquired by ED and F-Man, a much larger fund, Harding found himself constrained by the bureaucracy of the parent company. He realized that to truly leave a legacy, he needed complete autonomy. In 1997, David Harding founded Winton, intending to fully embrace the scientific and data-driven methods of finance, free from human interference. But what he did not know was whether his radical vision would succeed. Winton launched with just $1.6 million in assets under management. Thanks to Harding's scientific approach, the fund quickly established a strong track record, returning an average of 15% net annually during its early years. By the mid-2000s, Winton's AUM had skyrocketed to billions of dollars, solidifying its reputation as a leading quantitative hedge fund. Winton's initial success was built on trend-following strategies, where it identified and capitalized on long-term price movements across commodities, equities, currencies, and bonds. This systematic approach allowed the firm to thrive during periods of market volatility, often outperforming traditional asset managers. Winton became known for its focus on empirical scientific research, employing a team of physicists, statisticians, and other scientists to analyze vast amounts of market data. Harding famously emphasized that Winton was more of a research organization than a hedge fund. This dedication to innovation helped the firm maintain a competitive edge. Winton would go on to become a $30 billion hedge fund by the early 2016s. In the meantime, the entire hedge fund industry would be revolutionized forever. By the early 2000s, one man had reaped the rewards of the trend-following strategy for decades. His name is John W. Henry. He had established himself as a trailblazer in the world of finance, pioneering trend-following strategies through his firm, John W. Henry & Company. His disciplined, data-driven approach to trading turned a small operation into one of the most respected names in systematic investing, managing billions of dollars at its peak. And now, he wants to show that the discipline and precision of markets can translate to the world of sports. Using his immense wealth, he acquires the storied Boston Red Sox, determined to break an 86-year championship drought and redefine the game, just as he did with trading.
Former Florida Marlins owner John Henry and his partners completed their record $660 million purchase of the Boston Red Sox on Wednesday, ending 7 decades of ownership by the Yawkey family and its trust.
After acquiring the Boston Red Sox in 2002, Henry applied the same disciplined, data-driven approach that had defined his success in trading. Partnering with Theo Epstein, a young and analytically minded general manager, Henry embraced the groundbreaking principles of sabermetrics, using advanced statistics to evaluate players and optimize performance. The results were nothing short of historic. In 2004, the Red Sox shattered the infamous Curse of the Bambino, winning their first World Series in 86 years. It wasn't just a victory for the team, it was a triumph of logic and strategy over superstition and tradition. By the 2000s, the world of trading had transformed. High-frequency algorithms, tighter regulations, and increased access to financial data created a more competitive landscape, testing the resilience of trend-following strategies. During the dot-com crash of 2000 to 2002, trend-following strategies demonstrated their resilience. As technology stocks collapsed, trend followers identified and rode the downward trends, generating positive returns while equity markets floundered. Investors began to see trend following not just as a speculative tool, but as a way to diversify and manage risk. Funds incorporating managed futures, heavily reliant on trend-following models, flourished during this period, offering low correlations to equity markets and delivering consistent returns across asset classes like commodities, currencies, and fixed income. Yet, by the mid-2000s, cracks in the trend-following success story began to emerge. Markets entered a period of reduced volatility and shorter, less defined trends, challenging the core assumptions of the strategy. As trends grew weaker and reversals more frequent, many trend-following funds struggled to deliver the outsized returns of earlier years. Some critics argued that the growing popularity of trend-following strategies had led to overcrowding, as too many traders attempted to ride the same price movements. By 2006, the U.S. housing market seemed unstoppable. Fueled by low interest rates, lax lending standards, and a frenzy of speculative buying, home prices skyrocketed across the country. Wall Street, blinded by greed and buoyed by the illusion of endless growth, fed the fire, creating a bubble so massive that its collapse would ripple through the global economy. By 2005, many trend followers began to notice cracks forming beneath the seemingly unstoppable U.S. housing market. Home prices were soaring, fueled by speculative buying and risky subprime loans, but trend-following strategies began signaling shifts in market momentum that suggested instability. With their systematic approach to identifying patterns and inefficiencies, trend followers started positioning themselves to profit from what their models suggested could be a catastrophic collapse. While they didn't rely on predicting the bubbles bursting, their strategies were designed to ride the emerging trends as markets began to unravel.
They are ping-ponging back off each other.
People are seeing this, and those memories of fear are coming back.
Procter & Gamble.
Procter's trading at 60.
I asked them what the heck is going on down here. I don't know.
All of a sudden here, we started hearing screaming, buy, buy, buy.
The 2008 financial crisis was a defining moment for trend-following strategies, with many firms and figures leveraging their systematic approaches to achieve standout successes. One of the most notable performers was Man AHL, a pioneer in trend-following and managed futures strategies. AHL thrived as equity markets plunged, commodities collapsed, and government bonds soared. Their diversified models, which spanned asset classes and geographies, captured prolonged trends and generated double-digit returns, while traditional portfolios suffered historic losses. Similarly, Winton Capital, led by David Harding, demonstrated the robustness of trend following during extreme market conditions. Winton's algorithms identified opportunities in falling stock markets and declining commodity prices, while benefiting from the rally in government bonds as investors sought safety. The fund's performance during the crisis solidified its reputation as a leader in quantitative investing. Other trend-following firms like TransTrend and Chesapeake Capital, led by Jerry Parker, also excelled. They capitalized on extended downtrends in crude oil and metals, shorted volatile equity indices, and rode the upward momentum in bond markets. Collectively, trend followers achieved impressive results, with the Barclay CTA Index, tracking commodity trading advisors, posting a return of approximately 14% for the year. After 2010, trend following faced a paradox. While the strategy proved its value during crises like 2008, the post-crisis decade brought unique challenges. Central banks flooded global markets with liquidity through quantitative easing, creating low volatility and strong equity trends that overshadowed many traditional trend-following returns. Funds that relied on identifying diverse trends struggled as markets became heavily correlated and range-bound. Despite this, trend-following funds, particularly those employing managed futures, remained resilient. During periods of uncertainty, such as the 2011 European debt crisis, these funds provided diversification, leveraging tools like momentum strategies in commodities, currencies, and fixed income. Managers such as the Man Group's AHL division and Winton Capital used advanced algorithms to identify opportunities in niche markets. The rise of popularity of exchange-traded funds, ETFs, during this period transformed trend-following access for retail investors. By simplifying the entry into these strategies, ETFs democratized trend following, but the accessibility came at a cost. Some investors worried that the influx of capital diluted opportunities, as more traders competed for the same signals. But just as skepticism about the future of trend following grew louder, an unexpected and unprecedented event would shake global markets to their core, revealing the true power of this enduring strategy.
Now to growing concerns about the deadly coronavirus officially hitting the U.S. Here's what we know.
Fast-breaking developments in the coronavirus emergency.
Officials declared a national emergency, triggering travel bans for non-U.S. citizens.
The U.S. has seen 1 million new coronavirus cases, and the death toll has surpassed 255,000.
COVID-19 pandemic revived trend-following strategies. As markets crashed in March 2020, these funds thrived in volatility, pivoting across bonds and commodities. Firms like Man AHL and 2 Sigma saw strong returns. As the world grappled with inflation and geopolitical tensions from 2022 onward, commodities re-emerged as a critical space for trend followers. Energy price surges due to the Russia-Ukraine war created new opportunities. Funds adept at spotting shifts in crude oil, natural gas, and agricultural products capitalized on these seismic moves. A new phase emerged with systematic funds leveraging machine learning and big data. These tools transformed trend detection, using unconventional sources like satellite imagery and social media sentiment to stay ahead in efficient markets. This fusion of technology and strategy marked a bold evolution for trend following. Simultaneously, the strategy became more accessible. Once limited to pricey private funds with 2 and 20 fees, it democratized over time. Mutual funds in the 2000s had high costs, but today's ETFs offer trend following at fees as low as 0.5%, welcoming advisors and retail investors without sacrificing potency. This shift has opened the doors to advisors and everyday investors, allowing them to tap into a strategy once reserved for elite institutions. Lower fees haven't diluted its power. They've only amplified its reach. Today, trend following stands as both a legacy strategy and a cutting-edge tool, capable of navigating the complexities of modern markets. From its origins in human intuition to its current reliance on algorithms and machine learning, the philosophy remains unchanged. Adapt to the market, follow the signals, and ride the trends.